Good afternoon. This is Tom Asprey with the Viper Report. It's Monday, February 10th, about an hour before the close. It's been quite a week or so in the stock market. We've sent out a bunch of special updates. This one was from last Wednesday, February 5th. We sent out a special one to both stocks and ETF traders, showing the action in the Qs. The fact that after this big red bar here was Friday's 600 plus point decline in the Dow, held firm on Monday, then gapped higher on Tuesday, which kicked the AD line back into positive territory. And it did make a new high on both a daily and a weekly basis last week. In that special update, I also pointed out that the brief decline had done little to relieve the overbought status. You can see the number of stocks above the 200-day moving average dropped from 80 to about 70%. As I talked about in past seminars, we're looking for it to get back down into this area in here where the market is getting a bit oversold and has a better rally attempt from those levels. Of course, one of the casualties of the coronavirus has been crude oil, which is just getting hammered, down sharply, for all year essentially. So this article in Forbes, there's a link in the email, so if you want to read it. In it, I talk about a real interesting technique some of you may not be familiar with. It's called seasonal analysis. And what it does is it searches the past data for reoccurring peaks and highs and lows for a given market. For example, in this crude oil example, we have data going back to 1984. So, that's a considerable 34 years or 35 years of data. And it shows a pretty clear pattern that, it tends to top in July and bottom out between December and February. So that's right where we are now. So even though crude oil has been getting sold pretty much and the sentiment is quite bearish, I thought this would be of interest to traders. And though we see also in the article I talk about the technical studies, real no signs of a bottom yet, but we're watching it closely. In my weekend article, Will Dip Buyers Be Punished? I look at the nature of the rally last week. It was attributed to everyone buying the dip and bullishness for the year ahead. And it was more euphoric trading than I've seen quite a while. Tesla went from 700 to over 900 and back down to 700, all within the space of the week. So my concern here was that the risk control at buying at last week's level was not that good, and that we really didn't know that much about what was going on with the virus and what the impact might be economically. In the article, I discussed the intraday action in the S&P futures, which I follow pretty closely. It had a crazy week, from declining on Friday in that 600-point decline, firming in early Monday, and you can see what a ride it had, peaking at 2 in the morning Friday time, and then correcting as the week finished. The technical outlook for the stock market is still really positive. You can see that the AD line for the NASDAQ 100, that's the market-leading index. It was the leader again last week. It made a new high and is still very strong. No signs of a top here. However, my concern is that once again, we closed above the weekly Stark band. You can see that's been the case for about most of the last 6 weeks. And I've been doing this for a long time. And when you get near the upper or the lower bands, the market usually will change direction. You can see back here in May and June of 2019, we had that correction, took us right back to the lower band, and the market took off. So this makes me nervous. It suggests that we will see a more substantial correction in the next few weeks. I also updated my analysis on Treasury note yields because I had commented several weeks ago in Forbes.com that rates were headed lower due to this technical formation, and that still appears to be the case. That's made our positions in the XLU and the interest-bearing stocks quite profitable. Though it's tough to buy the S&P or the QQQs here, there are quite a few stocks that I like. Back last Wednesday, prior to the regular update on Thursday, I recommended two stocks, BioTelemetry, Beat, or Palo Alto Networks. When I recommend a stock like Palo Alto Networks, I look at all time frames. So this is the period from last week. We were looking to buy it on this pullback. Our first buy level was hit. It's had a really good run from there. We're already up, had a nice gain. That allows me to move up the stop, which is typically what I do. Initial stop, and I try to keep it under 5%, but then once the position goes in our favor, then I raise that stop up. But it's also important to look at the longer term nature. So for PNW, I looked at this weekly chart and saw that we are not that far below this major resistance line here that goes back to early 2019, suggesting that we could see a breakout above that. And if we can see a breakout above that, we could go much, much higher. And usually I look at both the weekly, daily, and hourly to pick my buy levels and also to take profits. Well, that's all I have for today. If you'd like some more technical information, go to Viper Report. There's a couple of articles that you will find interesting, I think. And of course, if you'd like to subscribe to one of my premium services, there are links here for the Viper ETF report or the Hot Stocks report. Each comes out twice a week and includes 6 trading lessons, just $34.95 a month, pretty in-depth reports. And as I note at the bottom of the email, if you'd like to see a sample copy, just drop us a line and we'll send you one. Well, it should be another interesting week for the stock market. We see if this rally can continue to the end or whether we'll find out more about the impact of the coronavirus. So stay tuned.